Brian, thank you so much for making the time to join us today. I know that you'll be sharing some insights with us with regards to global equity opportunities across the borders. So I'm going to hand over to you and we'll catch up in a few minutes.
Sure. So thanks for having me. And I would say, the first thing, if we're thinking about valuations and opportunities, if you're starting from an index perspective, is I think a bit to unpack the index. And so I think there's a deck from Apollo about late last year that said that the top 10 names in the index traded a 50 PE, and they're somewhere between 35 and 40% of the index, which is kind of a record relative size over time. And so if you move out of the top 10 or the very top heavy weighted nature of the index, there are a number of good businesses that are trading at reasonable valuations. And so for us, philosophically, we have a total disregard for the indices. And so we start company by company, and our portfolio is built without, kind of any matching or consideration to what might be an index weighting. We own about 50 companies on average over time. And so that lets us be fairly choosy in terms of what businesses and what valuations we want to pay. In terms of mechanically, how we go about doing this is we cover a universe of high quality franchise companies. And when they become available at prices that we think represent good value, we've pre prepared ourselves to be able to act and buy. And so the other types of companies we look at or types of investments we look at are what we would call commercial opportunities. And those are average businesses available at extremely depressed valuations. And so that approach or that philosophy has allowed us to build a portfolio that trades between 27 and 60% discount, depending on whether you're looking at earnings or book value, to the S&P 500 that you were mentioning earlier. And according to Wall Street analysts, the companies in our portfolio are expected to grow 50% faster over the next 3 years than the components of the index. And so I think that the quick version of this answer would be that it's fairly straightforward to find opportunities that look different than the index if you don't start with the index as your sort of hunting ground. So we start very broadly. We start with companies, we start with fundamentals of individual businesses, and then we let the valuations take us where the opportunity presents itself. As I've mentioned, we don't start with an index or a top-down perspective. But over the last few years, we have found that the portfolio has moved increasingly away from companies domiciled in the US. Currently, less than 60% of the portfolio is in companies domiciled in the US, and about 4% of the portfolio is in businesses that are domiciled in emerging markets. The thing we pay a fair bit more attention to rather than country of domicile is where economic activity is taking place. And with regard to revenues, about 45% of the revenues of the businesses we own are in the US, and about 17 to 20% are in emerging markets. In terms of Mexico, we have a less than 1% position in businesses domiciled in Mexico. So it would not be a major focus of our portfolio at this time. In terms of areas of opportunity, I wouldn't point to necessarily one geography, but one commonality among the businesses that we've been buying over the last 18 months is that, with one exception, they've been sub $30 billion market caps. And so these would be mid and small cap companies. So we think there have been much more attractive opportunities in mid and small cap companies than there have been in some of the larger mega caps. Thank you. This is really a valuation driven decision, as is most of our portfolio. And so we don't have any particular dislike or embargo on the IT sector. But what you will find over time is that we have very different weights among sectors than what might be in the index. And that's always in response to what we're finding on a fundamental bottoms up basis. Healthcare has been under quite a bit of pressure. And in fact, the industry has currently trading at the lowest relative and absolute multiple that it has held at any point over the last 10 and 30 years. Now, to refresh you on some of our history, back in 2012, healthcare was actually the largest exposure in our funds. And then as the sector became very popular and experienced some mania during COVID, we actually exited entirely and had our exposure at zero. And so we tend to like businesses within healthcare sector that provide goods and services to the healthcare, or maybe more specifically, the life sciences industry. And we like them because they operate in consolidated markets with long-term secular growth drivers and attractive economics characterized by strong free cash flow generation and high returns on invested capital. And in fact, we've continued to add to such names and bought new positions since the 6/30 reporting date. So in terms of Thermo Fisher and Eurofins, they are both market leaders in their respective markets, and they have meaningfully outperformed competitors from a perspective of growth and profitability over the past 5, 10, and 20 years. Both companies are run by long-term CEOs who are responsible for the company's strong performance over the long term. Now, we believe these are best-in-class managements that have consistently demonstrated shareholder-friendly behavior with regard to capital allocation. They've completed attractive acquisitions, and with excess cash, they've consistently paid dividends and returned cash in the form of share buybacks. Now, as noted earlier, we've been able to buy these companies at significant discounts to the market multiple. So by looking outside of the weightings in the index and considering the fundamental merits of the company, it allows us to build a portfolio that we think is fundamentally more attractive than the broad index. So it is true that healthcare has been a very tough place to be the last 5 years or so, but the starting valuation of the sector today is demonstrably different than, say, 5 years ago, which we think is very important as we continue to be strong believers that the price you pay goes a long way in determining your ultimate results. There's no one factor or characteristic that makes something worthy of a long-term holding. We're really looking for a combination of financial strength, business fundamentals, management capability, valuation, and businesses and assets that possess essential durability. So businesses and assets that are highly likely to be larger and more profitable and maintain their economic relevance in 5 and 10 years. Now, even outside of our top 10 holdings, our average holding period has been 5 years over the history of our strategies, which goes back over 30 years. And I would say that if you want to earn the actual fundamental results of a business, you need to have a long holding period. And we think that a longer holding period is a fundamental advantage for someone who is conducting traditional business oriented research in a world or a market that has moved to shorter and shorter holding periods. And so, well, there's no one right way to invest. For those people who are taking a business oriented fundamental approach, it's necessary to hold over the long term to earn the genuine returns of the business. Because over the short term, returns will be dominated by perception and changes in multiples rather than by the intrinsic growth of the underlying company. So, as we've discussed, we've been finding opportunities in healthcare and in mid-cap companies. There is no one specific theme I would point to or one specific geography. The businesses we've been buying have been global. So they've been both geographically located across the globe as well as conducting business and earning profit globally. And the sectors and industries that we've purchased recently or purchased businesses in recently are leisure, oil services, electronics, chemicals, consumer staples, in addition to the healthcare focus we discussed previously.
Brian, thanks so much for sharing those insights with us. Now, you've spoken a lot around your philosophy and the fact that obviously you look at, the type of businesses that you invest in, ones that are able to, pretty much weather any storm or be a lot more resilient. You mentioned that at the moment you obviously do have exposure outside of the US. You don't just look at it from a regional perspective, it's really about the businesses themselves. Now, when we look at things such as, I suppose, your emerging markets, again, we do understand that you look at it from a company perspective, but given that it's been such a volatile time in the markets where we've got a change in, political dynamics, where policies are changing all the time. There are some regions where I suppose, where markets might be a bit more vulnerable, especially as you mentioned again, that you do have exposure to, say, the small to mid cap. How do you balance that, given that there are some factors that you can't, I suppose, get away from, and also just looking at the potential that a specific business may present?
Yeah, thanks. So I think the first thing I would say is that there is always uncertainty and there will always be changes. And so if you think about our lived experience of an average holding period of 5 years, that means in the US, we will go through, at least one presidential cycle with our holdings. We will probably, if you think globally, then go through dozens of elections in terms of the various countries that businesses might operate in. You're likely to have significant changes in interest rates over that period of time. Currencies certainly can fluctuate dramatically over a 5 year period. And so you want to, or we want to invest into businesses that have characteristics that should allow them to perform somewhat independently of what the various tides might be. And so now that doesn't mean that they won't experience better performance under one interest rate regime versus another. Of course they will. But if you buy a company at a reasonable enough valuation with a management team seeking to perpetually improve the company's position, all of the rest of that kind of washes out over time. And so we don't spend a lot of time or really much at all thinking about the unknowables, right? Where will currencies be? Where will rates be? Will event X, Y, or Z happen? And you know, we can think, through this in the last 5 or 6 years. If we just rewind the clock, I suppose, what is this, 6 years? you know, Most of the people watching didn't know in the middle of 2019 that COVID was going to happen. At the depths of COVID, they didn't know that a vaccine was shortly to come before the end of the year. And then I recall a period when interest rates were at zero and in negative in much of the world. And I don't think many people thought rates would go to 5%. And so if you perpetually try to predict the unpredictable, then you'll need to trade a lot. You'll need to swing around. You will need to get disrupted by, I would say, the winds of the day. But if instead you focus on, durable trends, we mentioned healthcare earlier. Will the global world want to treat more diseases and live more healthfully and sort of prosper on the back of that? Yeah, that's a durable sort of trend and idea that, if you can find businesses that serve that in an economically compelling manner, that will probably do well kind of no matter what happens with sort of the global macro factors. And so that's what we spend our time thinking about rather than trying to predict or respond to things that are highly likely to change and inherently unknowable.
Ryan, thank you so much for that answer, and yeah, and I guess also just helping us to understand how you think when it comes to your approach in picking those resilient companies or those winners for your portfolios. Thank you very much, Brian. That was Brian Selmo. He is the portfolio manager at First Pacific Advisors, and of course, giving us a sense of how they approach their investment opportunities across borders. Oh, that brings us to the end of today's session. A very big thank you to all our speakers and, of course, to your audience for joining us today. We really hope that you found this valuable and hopefully that this will help with some of your investment decisions. The recording will be available soon, and we look forward to engaging with you in future sessions. From all of us, goodbye and do take care.